Okay, in this video, we're going to get some of the key outputs from a project finance model. We're still keeping the financing relatively simple, but why don't we make a little picture of what's going on? We'll have our sources and uses picture, which we essentially already really have. We don't have our development fees yet, and we don't have our debt service reserve account, and we haven't kind of fixed it for the sources uh, for the capitalized interest, but we have the rest of this stuff. Okay, and I think we can just take this from our project finance model. So we have what I kind of say is that this provides a picture of the project during the pre-commercial operation date phase. I won't say marriage date phase, but that's what I use some other times. And then afterwards, if we want to compute a couple of the basic statistics, let's just compute our IRRs. And we'll put project pre-tax, project after tax, and we can also put now we're going to get the equity IRR, and then we can also compute the debt IRR. And let's put that pre-tax and IRR after tax. The after tax will recognize the deductibility of the interest expense. And finally, let's put the equity IRR. And we can, for all these IRs, we can put the nominal level. Oops. And then we can put the real level. Now, at some point, we'll also put all of the operating assumptions. We'll summarize something like the gross capacity factor. How about the temperature? Adjustment. Maybe we'll put the performance ratio. And we can put the net capacity factor. Okay, and then we'll be able to push these assumptions up and down. And when we push these assumptions up and down, we can see kind of what happens to all of the items. And we can put USD thousands here, and then after we put that, we can put SD per kilowatt, or maybe we could put percentage, and then we can put USD per kilowatt. Okay, that's where we're going. This, you know. Okay. Control down, Shift Control P, and we can do the same thing here. And Shift Control P. Now, if we would get fancy with solar, we can call this divided by kilowatt hour peak. I guess that's what P means. It's the DC power, not the AC power. It's how much the capacity is measured by the standard temperature conditions. Okay, and so let's get enough to fix this. Now we've got a couple of these already done. We have the pre-tax cash flow. How about after working capital? The project cash flow. And oops, that's in operations. So there we go. Here's the after-tax cash flow, and now we'll fill in the rest. Okay, perhaps we'll do this one a little bit afterwards. Okay, and to do this, I hope it's going to be pretty straightforward. We did really the difficult part, filling in the profit and loss statement and the cash flow statement is really pretty easy. I added too many lines. Let's put the revenues here, less the operating costs, and then we'll get the EBITDA. And then we put less depreciation on the capex. But you know what we also have is less depreciation on the IDC. We also have less depreciation on the development fees, which I understand that is deductible for taxes. And by the way, for now we'll assume that tax depreciation and book depreciation are exactly the same, so we don't have anything. And then we put any deferred taxes rather. Then let's put some amortization of the fees. Now here's kind of the problem. This idea of splitting the operation from the financing works, I think, really pretty well, except once all these depreciation and amortization items, they're financing related, so we can't compute that in this operating section. We have to compute it in our next section. So then we can get our EBIT, and then we can put less, of course, the interest expense. Now this, I think it's a lot better to do this profit and loss, well, by definition, that's what you really have to do. There's nothing during the construction period. This is just interest actually expensed. The interest capitalized during construction is here. And then we can add interest income, and that interest income is on all of the reserve accounts that we're going to have, all the cash we have left over. And then we have put EBT, that interest income. And then let's call this EBT before the NOL, net operating loss carry forward. Now, if this is in the US, there's no carry forward. You can kind of transfer your tax benefits outside of the entity, the special purpose vehicle. But let's put a standard one. So we'll put opening NOL. We'll add to that the NOL created from the tax loss, and subtract the NOL used from taxable income, and then we get the closing NOL, and finally we'll get the EBT adjusted for NOL. Now finally once we have that, we can put the subtract the taxes paid, and finally we'll get the net earnings, which we really don't care about much. Some people care about it a little bit. No, because it really project finance is so cash flow based. So let's then compute the cash flow waterfall after COD. We can start with our EBIT, EBITDA. This time take away the working capital changes. And oops, see, it's right here. Okay, it looks like I'm going to have to add some rows for this. Okay, and after we subtract the working capital changes, let's also subtract the taxes paid. Let's add the interest income. And now we have, I think that's, we should add the, this is the working capital reserve used. Okay, that has nothing to do with the profit and loss. It's only on the cash flow, and then we can call this CFADS. And then we can take away the interest expense that we just have up there, but we also have to take away the debt repayment, which is part of the debt schedule up there. And then we have the, how about we'll put net cash flow. Now after that we can put less the DSRA changes. This could be negative or positive, and we can cash after DSRA. Now we could put some programming to take money out of the DSRA if we have a bad period. And finally, how about we'll have net cash flow. We can also put between here and here, this is where really all the cash traps, cash sweeps, and all of those have to equity, and we'll just for now assume that's a dividend. Okay, now I think what we should do here is put in a balance sheet right now. Somebody from my class suggested this, and I think it's very good. That they said, well, do a balance sheet, make a balance sheet almost immediately. You know, before you even put debt in, you could have made a balance sheet. Now, to make the balance sheet, we need an equity balance account. And we can put, like other things, an opening balance. We can add the equity issues. That's what, we have upstairs. And then we can add the income that's from the income statement. And then we can put less the dividends. And we really have enough here with the equity issues and the dividends for the equity cash flow. Okay, well, we might have a little bit of a problem with the development fee, but I've just decided right now, made a decision, big decision, to do that later. Now, once we put the asset sides, we'll put DSRA. That's going to be in this section here. We don't have it yet, but we'll have somewhere in just below the permanent debt. Will, in fact, I'll just get ready for this. Nothing fancy here. We'll put DSRA balance. We have to figure out how much we need and all that, which is going to be the hard part. We'll put the opening balance, add the put in the contributions and then take away the changes. And then we'll just get a closing balance. Okay. Now this is the key behind the balance sheet, is that really every single item here will have a closing balance or something like that. And then we can put the AR balance. And if you look up to the top, we have, when we transferred all the variables in, we have accounts receivable and accounts payable balance. So we already have all of these defined. Then we can put a net plant balance for the EPC costs, and then we'll put net plant balance for the IDC costs and net plant balance for the development fees. Now, of course, you could have, separate these out. There could be different depreciation policies for each of these. And then we'll also have the net unamortized fees. Okay, and I think, I can't think of, I'm sure we'll have some other accounts perhaps, but let's put total assets for now. And then we'll put liabilities and capital. And I think we put some accounts payable balance. The other thing we had was we had a reserve account. We had a working capital reserve account. Okay, and then we, underneath the accounts payable balance, we put the construction debt, permanent debt, and equity, and then we can put total liabilities and capital, and then finally we can put a difference, and then we can put a check. Okay. Now, let's just start filling some of these in. Okay, I'm not going to even fill in this one, except we'll do what we do with every one of these accounts. The opening balance is the closing balance, and then we'll add the difference. Okay, Shift Control 1, Shift Control R. Okay, that's going to be a whole nother video, and then we'll get the revenues, which we brought in. Hopefully I brought those in. Here are our revenues. We go up and get our operating costs, operating expenses, and then the difference is the EBITDA. And the only thing I might do here is make some underlines, because I think that helps. Now, the depreciation on the CapEx we have, that's our base depreciation expense, but we don't have this other depreciation stuff, and actually that's perhaps the biggest real subject of this video, so we have to put other depreciation and fees. Okay, and let's put IDC, and then put the opening balance, add the IDC recorded. It doesn't matter if you capitalize it or not, get a closing balance, and then we can get our depreciation rate, and then our depreciation expense. Okay, that's really pretty easy. And we can do almost exactly the same for the fees. So we can just copy this and put depreciation on development fees, and we put, I suppose we can call it fees recorded, and finally we'll get the amortization on the fees during construction. Okay, we call it fees. I'll call this development fees. Okay, and then we get an amortization rate. And an amortization. And in a way, this is causes some real pain, because when we make the sculpting, these things, the one thing all of these things do affect is they affect the taxes. Okay, what I should have done is also added 2 lines to each of these. One for accumulated depreciation, and the next one for net IDC plant. Okay, that's what's going on the balance sheet that we just showed. Okay, and then we can put the same here, shift spacebar, and then of course Control C and Control V. I wonder if I could do, and then that's going to be net development. Okay, and okay, and then we'll get this one, and finally I can put this in. I guess this was silly. I should have put it down here. Excuse me for that. Okay. Okay, and then we got accumulated amortization and net amortization. Okay, and then so now we'll fill in the rest of these, and let's do this. You can tell how excited I am about doing this. I find it's so tempting for me to pretend this doesn't exist, but we can't. So this gives you the interest during construction here. Okay, Alt equal, the depreciation rate. I'm going to cheat just a bit, because let's take the depreciation expense we have divided by the gross plant balance, shift control P. The depreciation expense is just this times the opening balance, and accumulated depreciation is this plus this. Net plant is the closing balance minus the accumulated depreciation. Okay, and the same thing here. Opening balance is closing balance. Fees recorded. Fees recorded is here. Total. Where's the total fees? Oops. Excuse me. Oh God. Total fees during construction. It looks like I spelled it wrong. And alternate equal, and the depreciation rate. This is the fees, the development fees, which you know, I didn't put the fees in really yet because we need to work on that separately. So I'm going to leave that. I'm going to leave that out, and we'll fill in the depreciation expense, okay? And accumulated depreciation is this, and the net plant balance is the closing minus this, and our opening balance is equal to our closing balance. Now the fees recorded are the up here, which was total fees during construction, alternate equal to add the two, amortization rate. Now that's a little bit, let's put tenor. Okay, and now you could amortize this. This really depends on the tax law. That's the key thing you really wanted to worry about, not the book taxes. But we have 22 years, and that means that if we multiply this by 2, this is, I know we should have done it fancier, but our amortization rate is 1 divided by, by this. Okay, now Shift Control P. Now the amortization expense will be this times this, but we don't start it before in fact, we don't do it except the debt repayment period. And actually, then you have to really use a minimum function, okay? And then the net amortization is the closing balance minus the accumulated depreciation. So now we have the depreciation on the IDC. Okay, and we have the depreciation on the development fees. And we have the depreciation, amortization on our other fees. And that was pretty boring. And then we subtract all of these depreciations, and we get our next subtotal. Okay. Finally, let's get the interest expense from our from up here. No, our permanent debt. Where's the depreciation? Come on, interest expense. Permanent debt. There it is. It was the kind of the last thing we did. Interest income, that's going to be around the debt service reserve account. Oops. And oops. So now we have the net before the NOL, which is minus this plus this. We might have some I think we should make a potential for a letter of credit instead of a debt service reserve account. So that's what we'll put. So this is just simply maximum. And if this number here is below 0, so you put a minus, and then you put 0. What that does, that statement just switches a minus into a plus. That's all that statement does. And then we say, well, let's figure out what to do if this is a positive. Whoops, didn't put the 0 in. And then, but we cannot. When it's a positive, we take the minimum of what we just computed, or the opening balance. If we don't have anything in the opening balance, it's ridiculous to compute. I hope I did that okay. Closing balance is the opening balance plus what we put in minus what we take out. And the EBT adjusted for this is this one. We add back the amount we put into the account, take the amount out, and we have another thing, and then we can put the tax rate, okay, which we put in our operating assumptions. Hopefully we put that just above uh, this one, so we multiply that by the tax rate, okay, and the net earnings are this minus this. Okay, and then now we just start filling in this one. It's almost easier to fill in the cash flow statement. It's just this, and then we have to look a little bit up to the data we transferred to get the working capital changes. And just below that, we said, okay, we also used something from this working capital account. And where is the balance of that working capital account? We're going to need that. We're going to have to get that from our transferred variable. Now, the taxes paid are just from above, and the interest income we can just get from above, which we haven't computed. We should make it consistent. And then again, I'm using the positive number convention. Okay. And we take away the interest expense. And we go up and take the debt repayment. Okay, and then we get the net cash flow, which is this minus that. Okay, and then that's the difference. And then the debt service reserve changes we haven't computed, and we can put the difference here. And then we have the net cash flow to equity, which is just the same. I don't need that. For now, we'll just say the dividends is equal to this. Okay, and now the opening balance again equals the closing balance. And the equity issues, well, that's we need to get from really the funding analysis we did up here. And you remember way before we did this, we have the equity funding applied. And the income is only from the profit and loss statement. The dividends are just from the cash flow statement. The closing balance is this plus the income plus this minus the dividends, okay? And now the rest of it is filling in accounts. Okay, so we fill in the debt service reserve account. We fill in the accounts receivable balance from this stuff we transferred. Okay, and we didn't get this next one. Whoops, this is the one I wanted to get actually. So let's see if we can do this. This will be a good little reminder. So this was sum if s, and we have enough stuff here that we can just add another account. So if we want to get the working capital reserve balance, I hope maybe I was kind of thinking perhaps we would really recompute this here, but remember, if you use the sum if s, everything comes from the beginning. You first start at the beginning. And we have this working capital reserve account. And let's press Shift Control R. Assume, do we, oh shit. No, that's okay. Oh, we have it only in one single, uh, uh, we have it in one single time. And use of working capital reserve, this looks a little bit funny. 87. This should have 87. Shouldn't have been 87. It should have been 86. Okay. Excuse me for that. That shouldn't have been really recorded, that mistake. Okay. And then hopefully it gets taken out the next year. So it's kind of very simple. When we did it like this, it could last in two periods, you know, if we, oops, oh God. Okay, you don't really care about my other video being finished. Okay, and now we can fill in this account. Again, we're just filling in all of the accounts. I hope I didn't make too many mistakes here. We have the working capital account, and then the net plant on our EPC cost is, well, I'm going to violate my rule because I have to take the net plant and subtract the accumulated depreciation. That's very bad. IDC net plant, that's why we did it up here. We got the closing balance of we had the net IDC, and then we get the net fees. Now it's taking a long time to do this, but I hope you get the idea. The idea is when you get to the balance sheet, everything's already there, and then you press alternate equal. Of course, you put this in. Now, then you can put the accounts payable balance, which again we transferred that one using that technique where we had to use the sum if s and get a couple of things. Now the construction debt is up here. We have the permanent debt, and we're looking for the closing balance always. I'm getting close. Here's the construction debt, okay? And the permanent debt is the same issue. We go up and look for the permanent debt and get the closing balance. And the equity is just from what we did up here. And some good news, it's not really very good news, is that, oops, but, shit, sorry, alternate equal. And the good news is that in one period we balanced. Sometimes I can't even get one period right, okay? How excited. And then you can put round tab, this, comma, let's say 2 equals 0. That's how we'll make our test. And ultimately, we'll make our final test. Now, I don't know what I did here. The equity cash flow is the equity cash flow is the, why don't we just take it from here? It's the dividends minus the equity issues. Now, I think we're going to have to make an adjustment for for let's here. So and I'm going to kind of let's see CFADS debt service. I was going to kind of make an annual page this time, but let's stop. Let's do that a little bit later. So for now, let's just take the CFADS, and then the debt service is the interest plus the principal. Okay, and when we compute the DSCR, you can do it kind of two ways. You can take this, divide by this, you'll get a divide by 0, of course. You can put an if J263. That's the, I hope that's the, J264. 3. Okay. Now, it's a little bit better. It's key to get a false here. 0.1 or something. That's actually kind of important to do to make it like that. And now we can select the whole area here. Okay, and all the way down to the DSCR, Shift Control R, and I'm talking while it's copying. Hopefully, why is it taking so long? Here we go. And let's kind of look and see what happened. The depreciation on all of this stuff better not begin until, so here's the depreciation. It doesn't begin till our commercial operation date. Same with the amortization. Net amortization, we should put a little check to make sure that that really goes down to 0 like it did. We've got the EBITDA, EBIT, which even that was negative, so we do have some net operating losses, and eventually we start paying taxes. Okay, but it takes kind of a long time to pay the taxes. And then our CFADS is here, and we finally have some dividends. And let's look at the thing I'm afraid to look at. Oh shit, see, I knew this would be a problem. Well, the good news is we have some zeros, and even better news is we made it through here, and then there's a mistake. Okay, and the first thing to look at with a mistake, I could claim I made it purposely, but I didn't. 1650. You kind of look for something like 1650. Now, if you made multiple mistakes, which is probably the case. Oh, there's the 1650. And we have earnings before NOL of minus, and this number shouldn't have been this one. It should have been the EBT before the NOL. Okay, so that's pretty good. That helped us. That little balance sheet check. I hope you see how that really helped us. Now, and look at this. Can you believe this? And then we have some divide by zeros, which I suppose we'll fix. But the real good news is all that worked. Then once we have the DSCR, we can perhaps put the minimum DSCR here. Okay. And we can also compute the equity IRR. Now I'm afraid we have a divide by 0 here, so we better go and fix this. Looks like what happened is 1 divide by 0, and we went crazy. And I think here's what this depreciation rate, there should be a law against ever making a formula without a test in it. Okay, so assuming that it just went to false, fine, who cares? And now we're okay, and we can get the equity IRR. Okay. Okay. Uh-oh. Sometimes. Why is this? There's clearly a problem with something else in this model, because that doesn't really make any sense, that the equity IRR, if the interest rate, we'll get the debt IRR next, but you know what I'm going to do is put this in here, and then we'll put the DSCR, LLCR, PLCR. I think we'll make that in a second video, because I'm getting sick of talking to my computer here. But we've at least done kind of the long and tedious part of the model. Okay, so here we go. Let's save this, and let's call this cash flow equations. Okay. All right, so let's stop. How about I'm going to pause and find the mistake in the equity IRR. Oh, great. Sorry about that. So the mistake I made, I'll just finish this off, the equity IRR. If we have this project finance, remember these dates are not constant, so we can't just use the regular IRR, and they're not annual, so I can't believe I used the IRR instead of the XIRR. So we put XIRR, and we select the whole area first, and then you select the dates. You can't just click on the whole line. Okay, so that's the IRR and the DSCR. So we're kind of getting started with this. So we can put in the DSCR. All right, and now I think let's have another video that works through some of the a little more advanced on the debt analysis. At least gets us the IRRs on the debt, and we'll put the PLCRs and LLCRs in that video as well, and we'll put some debt default parameters and just do a little bit of debt analysis, and we'll have another video as well on the development costs, and then keep pushing on some of the difficult issues, which are the circularity involving the debt and all of those issues. Okay, but this is long enough for this. Okay.